Hey, what's going on, my friends? It's your man Adam A. Spencer here with another M1 Finance Dividend Portfolio update. In this video, in this channel, it's all about making, managing, and growing money. But every weekend, I have my dividend portfolio update where we contribute $5 a weekday or $25 a week into this portfolio. And we're just tracking this journey of investing and growing my money. And of course, you guys get to experience some of these not so pleasant moments, some of these difficult times when it's, obviously time for me to look and see how everything's going with our portfolio, doing these updates because the market has been getting beat down pretty badly. And yet we are still here contributing, investing, growing this bag, as some will call it, because that's essentially what we got over here, a little bag. And there's no problem with that, though. You got to look at having a bag as a good thing. Some people will be like, oh, you're a bag holder. That's the better term, more specifically, that I was thinking about when it comes to holding a bag. Because some people will say, no, if you got a bag, that's a good thing. But if you're a bag holder, that term is what, day traders, I feel like, or people who are shorting stocks will often use as if it's a bad thing to be accumulating more shares of something when you're down on that particular stock. Now, if you ask me why, does it make the most sense to go and accumulate more shares when I'm up? I mean, I guess you can, especially if you really believe in that company long term. But if you had the best opportunity, the best chance, the best time to do so, to accumulate more shares specifically, is when it's down. And that is what we are experiencing right now with the whole market as a whole. As you guys can see, we got our dividend portfolio right here in the background, and things are looking pretty good over the past day, right? We'll get back to that in a moment. But at the S&P 500 is what I've referenced in the past as what I like to use to gauge, to kind of just see where I think the market's going as a whole. And we might potentially have, might have seen the bottom. But, about 2, 3, maybe a month ago, maybe a little longer than that, actually, at this point, I had made a prediction. And I was saying with the S&P 500, there are two different lines, two different areas that we might see. And I believe we're going to see both of them. We've already seen one of them now, and that's this lowest point here. It actually fell below it. It says 3,674. My prediction was 3,700 flat, and it hit it pretty much. It obviously fell right below it, and then the other area I said to look out for is 3,500. So we did kind of see support above 3,500 when we hit that low back on June 17th, but there's still a little more space down there for it to potentially fall more. And I believe, considering the way the market has been going, how people are saying, hey, the first 6 months of the year have been the worst start to the stock market since 1970. And that things could potentially or most likely will get worse. Well, that means there's a good opportunity that this ends up falling down more to that 3,500 zone that I was talking about. So, and at the same time, maybe we kind of have seen enough. It's, we've lost the momentum and everything from the first 6 months. Maybe it kind of consolidates at this place at this point for the rest of the year, and then next year it ends up going down more. Maybe not. Maybe it goes up a little bit more from at this point, and we did just see the bottom. No one really knows, but considering how high we were to the point here back in December, right at the end of the year, 4,766 is the highest point you can see from the 5-year chart. Maybe if we zoomed in, it might be a little more specific, but ultimately, that's 1,000 points. I mean, we've fallen down 1,000 from that high in just 6 months. The S&P 500, that is. And so, I mean, that's a lot in such a short period of time too. But considering how much money had been pumped into the market over the past 2 years, and how quickly we ran up from this 2,300 all the way up to that 4,766. Well, that's obviously quite a bit, but that is over the span of basically a little less than 2 years. And so, yeah, it's tricky, right? It's tricky, which is why we aren't doing a large sum investing approach where we just throw a large amount of money at the stock at one time. Because usually when you do that, that's all your money, and you aren't able to best position yourself to weather the storm, whether or not things are going to go up or down from that point moving forward. And so instead, with this channel, with this portfolio, I'd take a dollar cost averaging strategy, which is investing the same amount of money, which is $5 every day or weekday, or more specifically, $25 a week into our portfolio, regardless of how good when it's running up, or over here when it's running up, or how bad when it's coming down. And so the benefit of that is allowing us to hopefully find a nice average somewhere right in the middle of where we've been, the bad times and the good times. And so it makes your job easier as an investor. So if you're new to investing, if you're a beginner investor, this is one of the best strategies that you can implement, because saving up all your money and then throwing it all at a stock at one time, it's going to make it much more difficult to time that stock at its lowest price point while you are going to be holding that stock. I mean, if you decide, if you know you're going to just own that stock for a month, well, yeah, again, it's impossible to know if the stock's going to be higher or lower in a month from now, especially with the current economy that we're experiencing and dealing with in the market and whatnot. So, yeah, this is very difficult to time, and that's why we're not doing any kind of large sum investing approach. We're doing this dollar cost averaging strategy. Now, really quickly looking at this does look like we're in a downhill trend. Looks like it's going down, right? Just like you see it here, we're starting to run up. You can see it, that looks like a nice little path going up. Well, we can now see it doing the same thing here, going down. And who knows how low it's going to go, right? How low can you go? We don't know. But looking over here, this is, the 3,500. The way I came up with that was looking at the high point basically here, kind of over here, pretty much a little lower, but and you see it over here. So that was where I came up with that number. And then the 3,700 was at the low point right here, pretty much, because you can see it was like they wanted to push down. Nope. Ran up. They looked like it wanted to come down. Nope, wasn't happening. And so that's pretty much how I came up with those two different metrics, and how I decided, or just thought in my mind, like, hey, we see there looks like there's support at both of those zones, both of those areas. I would not be surprised if we hit those areas or that zone. And surely enough, we did fall right in between the two. And we started to go up, but it still looks like we might have hit like a little wall or something, and we're starting to fall back down if you looked at that really closely. So, yeah, very, very difficult times. And I understand if you are new to investing, if you're a little scared, if you're like, hey, I don't really know what to do with my money, I don't know what I want to do. Well, take a dollar cost average strategy. Just invest the same amount of money every week, regardless of how good or bad. Just set your account. For example, this is M1 Finance. I have a link down below. You can open your own account with M1 Finance. You can actually fund it with $100, and then they're going to give you like $30 or $20 or $40 for free. So use my link down below. Start your M1 Finance account, and then you can start to grow your money similar to what I'm doing over here. Despite the market not being so hot right now, at least you can see what the current value is of my portfolio. This dividend portfolio is $2,284.28. Over the past day, we're actually up 1.69%. Over the past week, we're up 0.02%. And over the past month, we're down 4.6%. Over the past quarter, we're down 10.12%. And over the past year, we're down 13.66%. However, all time, we're down 10.34%. Again, that gives us a current value of $2,284.28. However, we are down. Our gain is negative $156.44. Now, luckily, we've gotten some dividends that we've have been earned here, $95.14, and our market gain is actually down more than our regular gain here, down at $251.58. But of course, we have dividends in this portfolio, so that does help reduce the market gain loss that we have there and bring our total gain down to just $156.44. So things are going pretty well, I would say, considering the way the market is performing as a whole. Looking at our portfolio here, you can see Coca-Cola is performing pretty good right now, up 36.39%, followed by Pepsi, up 30%. Realty Income Corp up 20.53%, Johnson & Johnson up 18.79%, Procter & Gamble up 12.63%. Then in the red, we do have Verizon Communications down 0.82%, Newtek down 21.85%, JP Morgan Chase down 33.78%, 3M down 38.25%, and Innovative Industrial Properties down 56.53%. So, not everyone is killing it right now in our portfolio, but we do have some green here, and I will take it. If you guys saw our growth portfolio update yesterday, it's been a brutal ride for that portfolio so far, but we aren't stopping over here. We are going to continue to contribute every week, and it's oh so beautiful. Now, looking at our portfolio, you can see our total earned dividends again is $95.14. Of that, Newtek has paid us the most with $27.43, killing it. Ooh, I love it. Then you have Realty Income Corp, who has paid us $9.56, followed by Verizon Communications, $9.27. So the top three dogs are all almost at that $10 mark or above. So getting there, we're growing our money slowly but surely, and that is the beauty of these dividends, right? Every time we get our some activity in here and we get our dividends, we're not taking that money out and going elsewhere to spend it and balling out, splurging. No, we're going to use that money to buy more shares, buy more stocks. So when the price point does get higher over the years, in a year from now, 5 years from now, 10 years from now, well, we're going to have more money because we accumulated a larger number of shares while the price was cheap. And so, yeah, I'm loving it. I'm loving it. So far for this month, July, kicking things off, Coca-Cola has paid us $1.60 in dividends. And then at the end of June, you have Newtek, who paid us $6.75. I love it. Followed by PepsiCo, who has paid us $1.53. And then you can see Newtek, I don't know why it's two different dividends. That's interesting. This one here is for 30 cents. And that's it for the most recent payments that we've received in dividends. So, hey, I'm loving the way our portfolio is looking so far. Yes, things, we could be performing a little bit better, right? Things could be better. It would be nice if this wasn't down 10% and instead it was up 10%, right? I I would love that. But the reality of the situation is you have to have the good with the bad, right? You have to have the rainy days to enjoy and appreciate the beautiful sunny days that we have like today. I think it rained yesterday for like an hour or two, right? Some thunderstorms or something like that. Not long. It was a short-lived period, but it wasn't fun during that time. I just got my bike, my motorcycle. I had to run out, throw my tarp on it, and all that. Yeah, it's not ideal, but it is, to someone, at least, to something out there. Go ask the ducks or the fish. They probably love the rain. And that's kind of how you got to look at the market. While this is bad, I actually am loving this because the stock prices are cheaper of a lot of the stocks, the companies that I believe in or that are paying us these dividends. And it's like, hey, we have the chance to buy more innovative industrial properties in 3M and JP Morgan Chase, and Newtek and Verizon while I'm down while the price is at it, while it's cheaper than what I have it at for my average. And that's not a bad thing. That's actually a good thing. And matter of fact, my friends, that is why we are going to be increasing the amount of money that I invest in this portfolio, at least for the next 2 or 3 months at least. That's the thought moving forward. We're going to actually up the ante a little bit because the market is performing pretty bad. And it might be like this for another year or 2 years. It might be like this just for another week. I don't really know. No one knows. But I know I'm down on a number of good stocks like that I just mentioned, for example. And even some of these other stocks probably will have, a good chance for you to, again, just accumulate more shares of them while the stock prices are really cheap, while the market's not performing well, before it really starts to run again in, 6 months or 2 weeks or a year, 3 years, right? We don't know. But like I said, I consider these stocks, unlike my growth portfolio, I feel more comfortable with 95, 99%. The REITs, I would say, are the most iffy for me. Maybe Verizon, but they're even performing better than these other stocks that I feel more comfortable with, JP Morgan Chase, for example, or 3M. So yeah, in other words, I'll put my money where my mouth is. So we're going to up the ante a little bit for this portfolio, again, just at least for the next 2 months, 3 months. I wish I started this about 2 weeks ago, before we saw that bottom, where everything really hit the bottom, so to speak. But I have a good I have a good feeling, not chance, but a good feeling where it's not over yet, and that things are going to probably continue to go down. So now is a good time to up the ante, because if we do start to run, at least I'm getting that access to accumulating more shares, while some stocks are cheaper. And if it continues to go down, well, I've already set up my flow, the workflow, the automation to invest a little bit more every week into this portfolio. So, my friends, I'm going to wrap it up there. I hope you guys found this video helpful, motivational, encouraging. If so, definitely smash that like button. I hope you guys are investing and growing your money. Having it just sitting in your savings account is not helping you during these times. Inflation is just eating away at your money in your savings. So, I get it. You might need the money now. If you do need it now over the next year, 2 years, maybe 3 years, then yeah, don't invest it. If it's money that you can say, hey, I can put this off for at least 3 years, then I would consider investing it and growing your money. So, my friends, I'm going to wrap it up there. I hope you guys found this video helpful. Much appreciation for watching. But you guys already know what it is. I got to keep it moving. But I'll see you in the next video. Peace.